As I try to answer the question, why use EBITDA instead of profit, I struggle to give a good answer as to why to use EBITDA at all. EBITDA is often used by investors, business brokers and the like to value a business, but using EBITDA for business valuation purposes is flawed. EBITDA is flawed as a metric for valuing a business because it ignores depreciation and amortization, as if these are not genuine costs to the business. This simply isn't the case. It's true that depreciation and amortization are both non-cash entries in the profit and loss of a business, but that's no different to an accrual for a cost where the bill is received in the following month. But you don't add back accruals to adjust the profit for business valuation purposes because they are non-cash entries, so why add back depreciation? This makes no sense to me. Depreciation is effectively a delayed cash entry because although depreciation is a provision to write down an asset the business already owns, which is done over its useful economic life, you should also look at depreciation as a provision for replacing that same asset in the future, which means if depreciation is removed from the profit figure, which is what happens when EBITDA is calculated, you are not taking account of what these assets represent as a cost to the business from one year to the next. For example, in simple terms, if you buy a piece of factory equipment for say £10,000, which has an economic useful life of say 5 years, this asset will be depreciated at a straight line rate of 20% per year, or £2,000 each year. But remember, if this asset has a useful life of 5 years, that means it will need to be replaced in 5 years once again. If the £2,000 is added back to adjust the profits by this amount, the resulting EBITDA figure, if used for valuing the business, will overstate its value. For example, if you use the profit multiplier method to value the business, and let's say the multiplier you've chosen for the business is, let's say, 3 times adjusted profits, if EBITDA is used, the business will be overvalued by £6,000, i.e. 3 times £2,000. Now, you might say £6,000 isn't much, but this was just an example. Where this becomes a big overvaluation problem is when you have a business which is heavily capitalized. This happened to me when I was in the process of buying a business. One such business I came across was a transport business with expensive lorries on the balance sheet. And this same company had high amounts of depreciation on the lorries going to the profit and loss account. I found this business through a business broker who had valued the business using EBITDA, and they had added back depreciation in their valuation calculations. This meant that the business was hugely overpriced, but unfortunately the broker didn't agree, and more importantly, neither did the owner agree. Needless to say, I walked away from the deal and I didn't buy this business. So, coming back to the question of this video, which is why use EBITDA instead of profit, I can't see a good reason for using it. Some say it's a good method to compare one similar business to the next, but even this doesn't really make sense to me either. Depreciation calculations are governed by accounting rules, which means that most businesses will use similar rates for similar assets. If an asset has a useful life of X years for one business, in theory, it has the same useful life in another business. I understand the other add-backs of EBITDA, which are interest and tax, because every business will finance the business in different ways. Some businesses are financed using loans, and therefore there will be an interest charge in the profit and loss, whereas other businesses won't, so there won't be an interest charged. So by stripping out the interest in the business that's financed using loans, this will help when trying to compare it to one that doesn't have any loans. A similar argument applies to interest income, as the interest in EBITDA refers to interest paid and interest received. Some businesses may have better cash flow than others, and they may be better at setting aside cash that is deposited into interest-bearing accounts, whereas others may not be able to do the same if they don't have good cash flow and cash to invest in this way. So, by stripping out interest income from the business that has it versus the business that doesn't, means these two companies are easier to compare. Finally, it also makes sense to strip out tax paid from one company to another, as taxes can quite legitimately be manipulated in a manner of ways from one company to another, which means to compare one company to another, this makes it far easier to do so. Some people say that EBITDA shows income before non-cash expenses, but even this isn't the case, as interest, both paid and received, and taxes are cash expenses. I accept that depreciation and amortization are non-cash items, but I covered this at the start of the video. I am open to the suggestion as to why EBITDA is used instead of profit, but for now I'm not convinced EBITDA stands for anything useful. I've mentioned about EBITDA and business valuation and suggested this shouldn't be used to value a business. So if you'd like to know what profit to use to value a business, I suggest you watch my video on this, which is linked to above. If you have any questions on this topic about buying a business or any other aspect about the process involved in buying a business, please drop a comment below. And always remember that no question is a stupid question. If you don't know it, you don't know it. And by having the answer to the question you have might be all it takes to move to the very next step in your journey to buy a business. Take care, and I look forward to seeing you on my next video.